Welcome to Daily Wisdom from the Flippening Podcast. These episodes feature short, to-the-point clips from our full-length interviews. We talk to the men and women behind the trades, crypto exchanges, and regulations with the goal of helping you become a better, more informed investor.
Hi, I'm Michael Kaplan, editor of the Flippening Podcast. Today's episode is taken from a 2018 conversation with Sam McIngvale, head of Coinbase Custody, the world's largest cryptocurrency custody service. We discuss common custody options and their respective trade-offs. For the full conversation, check out Flippening episode 28. This episode has two sponsors. The first sponsor is Nexo, which offers instant crypto credit lines. Check them out at nexo.io. Our second sponsor is the Nomics cryptocurrency market cap and data API for institutions, fintech apps, and funds. Without further ado, here's our conversation with Sam McIngvale, head of Coinbase Custody. Enjoy.
Let's maybe shift gears and talk a little bit about your philosophy on custody and the range of options that exist. I've heard Ledger speak about this. They have an approach. I was at another event for institutional investors, and there was a company there that decided to approach this problem by simply storing private keys for people. So it was kind of agnostic to what the actual tokens were. It was really about sort of safely and in a sort of institutional kind of way, in a manner that's compatible with how institutions work. They were storing private keys for people. What do you think the spectrum of options are, and what are the different variables within that spectrum? Or I guess, as you sort of map the custodial landscape, what are some of the different dimensions that exist?
I love this question. There are a bunch of different dimensions, and there's maybe 3 or 4 that I'll key on. First thing I'll say is I'm really happy to the end goal of putting this custody issue for the crypto asset class to bed. I'm really happy to see so many different approaches and groups tackling this problem. We have our own view on how the world's going to shake out, but certainly we don't think one view is going to win. I think multiple views will be right. And it's good that there's so many different trade-offs and alternatives that are coming online in the market right now. So I think that's a net win for the space. The 2 obvious dimensions for just evaluating a custody product, a crypto custody product, I should say, are first security and asset selection. The good news is that most of the names you just mentioned, most of the names you've heard of, are using fairly conventional, fairly well-known means of storing crypto assets. Typically, this is going to be cold storage, some sort of air gap solution, probably leveraging some HSMs, typically leveraging time locks, ways that folks cannot quickly move these assets. And those are time-tested techniques. We know them to work very well. And typically when you hear about crypto hacks, right, you're hearing about exchanges, you're hearing about hot wallets, you're not hearing cold storage systems get hacked. So that's great. And I think there's just degrees to evaluate these groups across the security landscape. Certainly there will be more degrees forthcoming. The second is asset selection, and this is a tough one. Some groups are going the multi-sig approach, and that means that multi-sig needs to be implemented natively on the chain for them to offer a multi-sig wallet for that asset. We take a different approach, which is sort of more similar to just storing the private key, splitting up into a bunch of different pieces. This allows us to be a little bit more blockchain agnostic. But asset selection also is a function of your regulatory posture. That's one of the dimensions I'll come to in a second. How are you dealing with privacy coins if you're able to from an AML perspective? What about the security versus non-security issue? Those come into play quite a bit when it comes to asset selection. And I think if I was a fund, ultimately I wouldn't want to have to pick multiple custodians, or I wouldn't want to have to self-custody the bulk of my assets because my custodian doesn't support them. So I think that will be a really key dimension here, probably in the next 6 to 9 months, as a lot of these custody offerings come online and then buy for market position. The 2 that are maybe not quite as obvious, but in my mind more important, are going to be first versus third party. So are you holding the keys yourself purely in a first party offering, or is your custodian holding all of the keys themselves? And that's third party. Coinbase Custody takes the view that institutional custody needs to be solely third party. And that's what our offering is today. It is just third party. We have the option to pivot, and we can actually share some private key material with our clients. So we could be somewhere in between if there was a second party or a 1.5 party custody. We have that option available to us. But our view is from a fiduciary perspective, from a more traditional financial perspective, what Wall Street is accustomed to is third-party custodianship. That's how every custodian works in the equities world. So we think that's going to be a little more comfortable to most groups. I love that a bunch of groups are taking the first-party approach, and I think that will resonate with a bunch of businesses. Ultimately, we find ourselves right now on the third-party end of the spectrum. The last piece of the spectrum is regulatory posture. So if, and then if, how is your platform regulated? There's a bunch of different offerings. Obviously, if you're first party, you're more of a tech provider to the fund or the institution that's holding crypto. So in that case, you might be unregulated. If you're third party, you're almost in all cases going to be regulated so that you can service a broader client base, but you don't have to be. And I think it'll be interesting to see if there are some groups that take that approach.
How would you describe Coinbase Custody's regulatory posture?
Our view is that I think in line with our strategy, we want to be the most trusted. One of the ways that we're approaching that is by being the most regulatory compliant and having an open dialogue with regulators such that we can bring those insights and those dialogues back to our customers and help them make the right decisions for where and how they're storing their assets. The way Coinbase Custody is going to market, we are partnering with a clearing broker-dealer. So this puts us squarely under the SEC and FINRA regulatory regime.
That's it for today. If you like what you heard and want to support the show, please consider leaving us a review on iTunes, Stitcher, or wherever you listen to podcasts. If you decide to leave us a review after subscribing, we'll send you a free Nomics t-shirt. Just hit us up on Twitter at username NomicsFinance after you've left the review, and we'll hook you up. You may also be interested in Nomics.com, our crypto market cap and pricing website. Check us out at Nomics.com, spelled Nomics. Now stick around for our legal disclaimer. All opinions expressed by podcast hosts or guests are solely their own opinion and do not reflect the opinion of Nomics or any other company. This podcast is for informational and entertainment purposes only and should not be relied upon as the basis for investment decisions. The producers, hosts, and guests of the show may maintain positions in the companies or assets discussed today.